The reporting season can be overwhelming, even for the most seasoned professionals, let alone the everyday investor. There is a lot of noise, there are a lot of facts and figures. A key competency of my team is to sift through that noise to look at the real underlying drivers of the profit performance of companies during that reporting season. So we're looking at what management strategies are, what they're saying, matches to what they're doing. The initial process is to screen for quality attributes of companies. So we have 4 quality attributes that we screen. Firstly, favourable business position. Secondly, sound management. Thirdly, earning sustainability through the cycle. And fourthly, a solid balance sheet. And those screens effectively screen out potential poor quality companies and screen in good quality companies within that universe. A pitfall for a lot is that companies often like to demonstrate an underlying sense of profitability. So they adjust the statutory results to their view of what their earnings look like according to them. And that's a key for analysis to really sift through that and be quite sceptical, really. Revenues are relatively stable, low growth, but stable. That's giving management the opportunity to deliver reasonable returns to shareholders, but at the same time reinvest some of those short-term profits for long-term sustainability of growth of their companies. So the results that stood out for me are probably 2. One in the large cap space, which is Aurora, a packaging company, and the other is Reliance Worldwide, that's in the X100 space and recently listed on the stock market. Again, both companies met our expectations of good, strong execution of their strategies and strong growth coming through for those companies. And little change in terms of relative our expectations, but the reporting season and the clarification of those numbers and that growth provides confidence that we are on the right track in terms of our investment thesis. On the negative side, Telstra was probably the most disappointing in terms of the results coming through, in terms of impacting the model, our model portfolio stocks. Telstra cut their dividend from 31 cents a share per annum to 22 cents a share per annum. It had been paying out 100% of its profits in dividends for many years now. I think the market has realised that that was unsustainable in terms of completely paying out all the profits to shareholders in a short-term sense. Over the next 6 to 12 months, I think we'd expect more of the same in terms of reasonably low but stable sort of growth in terms of revenues of corporate Australia, more cost cutting and cost efficiency, but balanced with capital management and also reinvestment for growth. There's always potential X factors in terms of the geopolitical framework of the globe and even domestically. I think top of mind at the moment is the US political environment and also tensions between China, North Korea and the US at this point in time. Always hard to determine those factors. I think what we could say to clients is that our process and philosophy around selecting good quality companies, that those companies might fall during a shock to the markets or the broader environment, but those good quality companies tend to survive through those periods and bounce back a lot quicker than poor quality companies.